In this video, I will be going through a 3-step process for framing your trades that has taken me from living with my parents in a small town in Arkansas, working a job I absolutely hated, to now day trading full-time in Florida. As traders, you know, a lot of your trades that have hurt your progress have come from taking a trade that after you took it, you couldn't really explain to yourself why you took it. You were either over leveraging, you were over trading, or you didn't give your trades enough context as to why you should be taking it. If through context, location, and confirmation, you can frame your trades in a way that all align, not only will you take better high quality trades, but you will eliminate the downside trades that have been holding you back. The 3-step system is called the CLC rule, or context, location, and confirmation. Now, I didn't come up with this on my own. I found this from Carmine Rosado. He is a phenomenal order flow trader. I'm not trying to sit here and say I came up with this, but I have implemented this into my trading and it has benefited me a lot. So if you guys can find value out of this too, that's going to be great for everybody, right? So the first step is identifying the context. And I'm going to run through these relatively quick, and then we can actually get on chart examples and I can show you step by step how I use these. So context, looking at the higher time frame. Are we in an uptrend? Are we in a downtrend, or are we in balanced conditions? Now, it's good to understand the higher time frame narrative, because if you can identify that we're in an uptrend, rather than trying to short the market at a high, maybe you can wait for a pullback to a fib level, a demand level, a support level, an internal draw on liquidity, a fair value gap. Whatever your trading system is, you can look to long and go along with the buyers who have steadily pushed the market up, as opposed to trying to be a top ticker and trying to short the market when it is in a very bullish run. Same thing on a downtrend. If the market is falling and it is moving down very aggressively, why would you try to catch a falling knife and try to predict that the market is going to move up, rather than just waiting for a pop into a low volume node, a fair value gap, an internal demand level, an internal resistance level, and then look to follow the big sellers and follow along in their footsteps? Lastly, if you're in balanced conditions, you can't predict that the market is going to break through an area of support, break through an area of resistance, supply or demand. You can know that if at a low, sellers are failing to move the market down, buyers step in. Where can you target the next area of supply where we can find more sellers and buyers who are worn out, and then follow the sellers in their footstep, and you can just range trade like that as well. This is on a higher time frame, but it's good to know the overall context of the market. Now, the next step is identifying the location. When the market opens, if you are a New York session trader like me, maybe you trade London, maybe you trade Asia, whatever it is, you have to identify when you are looking to trade. I know what the context of the market is. We're in an overall uptrend, we're in an overall downtrend, we're in balanced conditions. Where are we at when I am looking to trade? If we are in an uptrend, let's say we're in an uptrend and the market is right here. Am I going to look to short down to the demand level, or am I going to wait for a pullback into the demand level and wait for buyers to be factored again and look to continue with the buyers? It is okay to short against an uptrend, but you have to understand that in an existing uptrend, you might want to not target external lows because you know the trend is valid. Same thing in a downtrend. Are you going to look to long up to these highs when you understand that the market has been moving down very aggressively? Are you going to wait for a pop back up where everybody else can buy and you can look to sell with the sellers who are driving the market down? You have to identify, is the trade that I'm looking to get into, is it valid with the already existing trend? Or am I in a demand level on the internal side of an already existing uptrend? Am I in an area of resistance in a downtrend? This will give you more conviction that your trade's going to play out, rather than trying to long in a downtrend because you're wanting to be a bottom ticker in this sense, or you're wanting to short in an uptrend rather than just waiting for the pullback and then getting in with the big buyers or the big sellers. And then lastly is confirmation. My system, the way that I trade, the way that I have found that this system works best, is after identifying the context and identifying the location. I use order flow tools like a heat map through Bookmap and I use a footprint chart to see who's in control between buyers and sellers in this range. If the context of the trend, the location of where the market is at, and then through confirmation identifying if a buyer or seller is in control in this range, if all three of these things can align and they tell you the exact same thing of where the market is going to go, you are going to have a much higher quality win rate, first of all, and you're also going to eliminate trades that may conflict. If we're in a downtrend and you're saying, okay, but we're kind of here at this internal support level and I kind of want to long this, but I'm actually seeing that buyers are kind of getting worn out, but I'm just going to hold my long. Do you see how it's conflicting? Those are the trades you want to avoid. And I'm speaking from experience as someone who used to just take trades without using this. And ever since then, I have become a much sharper trader, and I've known when the market is not aligning in the realm of context, location, and confirmation that I'm not going to look at the market. I've taken less trades and I've made more money since I've started implementing this system. And I want you guys to do the same. So through context, location, and confirmation, you are going to take the highest quality trades. Now let's get into an example from today. When the market opened, and I'm going to eliminate some of this so we can actually draw it all together and we can all be on the same page. When the market, or as we were coming into market open today at 9:30, what happened was the day before we had a sell-off from the New York high to the New York low, and we never broke one side of the range. So when the market opened up today, through Asia session, through London session, we were just chopping in the middle of this range. Now, on a higher time frame, I have a volume profile drawn out, meaning that these areas are low volume to me. Both of these areas have not had much volume transacted at, telling me that the sell-off was super aggressive. If the market were to revisit one of these areas, I could predict that sellers would be back in control, wanting to reload their position, and the market could short again. However, let's look at it on an internal side. When we had the sell-off yesterday, this area you can see here left a lot of low volume. As the market yesterday pulled up into this realm at the New York PMI, we sold off. It pulled up during Asia session, sold off. It pulled up during London session, consolidated in the range. And this is all happening as we are coming into the market open today. So I'm just getting the context right now, right? I'm saying, okay, we're overall bullish on a higher time frame, but since Monday, we've been selling off, and Tuesday, which was yesterday, we had this pretty aggressive sell-off, and we have this low volume node identified that we haven't broke through yet. This, to me, so far, is bearish. If I'm looking to short this, am I going to short these lows all the way down here at this demand level? Probably not, because we've already broke through this level and now it's acting as demand. What would I target? Probably this low volume node, this little area of demand. I can target one of these internal lows, but I'm not going to target all down here. If I'm going to short against an overall uptrend, I got to make sure my take profits and me exiting the market has to make sense, right? So I'm understanding this is the context, but we want to add more context, guys. We don't want to just have one or two things telling us to take the market short, especially when we're in an uptrend. I want to have 5 or 6 different things all telling me the same thing, because that is going to give me the most conviction in my trade if I'm going to be putting capital on the table. Now, to add more conviction to this red line right here is weekly VWAP. VWAP is volume weighted average price. It takes the average volume and the average price, and it's usually an area that if under, sellers like to re-add their position, and if we're above it, buyers, if it's revisited, want to add back to their position. It just shows you the overall trend of the market through volume and through price. As the market is pulling up during New York session, we are below VWAP. Now, let's add more conviction. Let's add more context to the trade. On the higher time frame, this same area of low volume here that we rejected out of, and let's see if I can actually drag it. This area of low volume is a high volume area on a higher time frame, showing me that this area there's been a lot of volume transacted here, and if we're below it, this could also act as resistance. So I'm saying, okay, now I'm getting more conviction that the market could go short Awesome. Now let's add more context, guys. Let's draw a fib. We could draw a fib from the high of New York down to the low of New York, and we could see, okay, as the market is opening here today, we're at the 0.5 of a fib level. That's a good area that the market usually rejects from. Let's draw another fib level from the New York high of yesterday down to the New York low of yesterday as we're pulling back, okay? Here we're at the 618 of a fib level, another area of rejection. It's not just the fib that's telling me that we're going to short, but it's the fact that we've also been consolidating in this low volume node, an area that we've seen the market break through below VWAP. Now we're at a fib level, and now we have context and location telling me that there is a chance that if the market can't break through this area of resistance, we could see a sell-off into maybe a low volume node down here, a low volume node right here, or we could sell off into this previous demand level from the New York AM of yesterday. So next thing we want to do is we want to pull up our order flow tools. I use Bookmap. So this was right at market open. I'm normally not a market open trader, but the setup was too good today for me not to take. So right here, going into market open, what happened was, remember, this is at a fib level. This is in an area of resistance in a low volume node under VWAP, context and location. I just need confirmation to tell me who's in control between buyers and sellers. So as the market's opening and we get a little rally up here, there's a big spurt of buying, and then it sells off, and then it comes back up and it fails to make a higher high, and it sells off again and it fails to make a higher high. At this same time, the CVD is growing. So there's more aggressive buying coming into the market, telling me that there's more market orders of buyers hitting the market than sellers, but it's not going up. For every buyer, there has to be a seller. If there's a lot of buyers that are aggressively marketing the market, there has to be passive sellers who are placing limit orders to absorb the buying with the intention of moving the market down. That's how I'm viewing it, knowing the context and the location of the low volume node, of the fib level, of the resistance level. You see how we piece all these things together? Now we go to a volume profile and we can see that there's more buyers, more buyers, more buyers, more buyers. There's more buyers aggressively hitting the market than sellers, but it's not going up. Context, location, confirmation. If that's not enough for you, let's go to a footprint chart, because I like ultimate confluence in my trades. I want to make sure that everything I'm using is all aligning in the exact same way. Cool. We had a huge rally up right at 9:20, 10 minutes before market open. And as you can see, the left side is total volume. The right side is delta, meaning there's 119 more buyers, 78 more buyers, 69 more buyers, 22 more buyers, aggressive market orders. And then on the next candle, it's mainly selling. At the highs, there's 83 buyers. There's 83 more aggressive buyers hitting than over here, and it's actually making a lower low. Weird. Next, as the market opened, we had a open, it goes to the high with more buying, but it's failing to move higher. And then we break back below and sellers actually step in and move the market down. Once we get a pullback, 400 buyers, 400 more buyers, 200 more buyers, 100, 200 more buyers. It's trying to move the market up and it's absolutely failing. Using this with context, location, and confirmation, seeing that aggressive buying efforts are failing to move the market up is showing me that the sellers are in control. And when I know that we are in an area of resistance, we're in a low volume node created from an aggressive sell-off, we're under VWAP, we are at a fib level, this to me is ultimate confluence to take the market short. Once we get a pullback into this low volume node created from sellers and we see buying attempts in this range with the CVD growing, showing that buyers are trying to buy, they are trying to move the market up. Where does it pull back to? A passive seller, where sellers are trying to reload their position. This was confirmation to take the market short, and we had a sell-off into our area of demand. And there was very little drawdown on this trade, guys. But this isn't the only example, and we can run through more. But today was just one example of how, by using the context of the overall trend, identifying the location, where are we at in the trend, how many different confluences can I stack a fib, a volume profile. I am an order flow trader. Volume is king to me. I can see the relationship between buyers and sellers. And when I know that this is aggressive sell-off creates areas of low volume, when the market revisits, I could assume that sellers are in control, looking to reload in their positions and move the market down. Then you go to your order flow tools like Bookmap. You go to your order flow tools like a footprint chart, and you can see that more aggressive buyers are hitting the market here, and they're failing to move the market up. This is showing me that there's a passive seller accumulating all of that aggressive buying, and that is when you can see the market move down. Now, let's run through one more example to the upside, how you can frame your trade for longs. This trade was on ES on June 27th, and this was a Friday. This is the same week that I was factoring in that throughout the whole week, we were in an already existing uptrend. It's Friday. The trend has been bullish for the last 4 days. I am not going to look to short the market on a Friday when we've already factored that buyers are in control. Am I against shorting? Not necessarily, but I have to understand that my targets can't be as far, and that I am not going to try to predict that the market is extremely bullish, that it's just going to automatically sell off when I have no context that the market's going to sell off. You see, if it's in an uptrend, I have no context that the market is going to sell off. So coming into Friday, what we know was we have been in an uptrend all week. And then let's add more conviction to our trades. Coming into the New York AM, let's draw a fib level from the low of Asia to the high of pre-market. Okay? We draw a fib to the low of Asia to the high of pre-market. Well, what we see is the New York AM low pulls right back to the 0.62 of a fib level, starts to reject a little bit. That looks pretty bullish to me. Cool. That's not enough. How about we draw a volume profile for more conviction? Cool. Let's draw the volume profile from the beginning day of New York, or from 6 p.m. Eastern open to right before the market opens. Would you look at that? And I'm going to draw a box to illustrate this. Right here, do you guys see how this is significantly low volume in this range? Where's the market wick through? This low volume area created from buyers that have pushed the market up. That's also interesting to me. What do we also see? London trended above Asia. Asia low, Asia high, London low, London high. The market is trending up in the overnight as well. Why am I going to try to predict that we are in a downtrend? I have my context through my fib levels, through a low volume node, understanding that the market is in an already existing uptrend. I have my context. Now I have location. As the market's opening right before open, we have a quick pullback to this fib level, to this low volume node created by buyers that I'm expecting them to defend this level. Once again, I need confirmation through order flow to see that buyers are truly in control in this range, because if sellers are the ones that are moving the market, then I can't take longs and go against what the order flow is actually showing me. But through context and location, I have a pretty good idea that I see that buyers are in control. So we go to our order flow tools. As the market is coming to open at 9:30, what we see is, I'm going to speed it up a little bit. As the market opens, we get a pretty nasty sell-off into the fib level, into the low volume node that we could call support in an already existing uptrend. Now, on this sell-off, let's look at the volume profiles. There's much more selling, 500 sellers, and the CVD is aggressively moving down, meaning a lot of aggressive sellers hit the market. But we get a quick reaction up. There's a lot of selling, but the market starts to move up, okay? Cool. Now what? The market starts to move back down. Here we can see again, the CVD is increasingly growing, or it's decreasingly growing, meaning there's more sellers. There's 1,421, and let me move my webcam out the way. There's 1,421 more sellers since this market is opened, and it is showing me that there are more aggressive sellers hitting the market, but we're actually not moving down, and now we're seeing a rally out of it again. You can see the CVD is increasingly going down. There is more sellers, and we can see this on the volume profile that at the lows there's a lot of selling, but the market is actually starting to move up. We hit a passive buyer. And increasingly, the market is moving up. Even when we see the CVD hit the market and all the selling is coming in, the market is moving up off of it. At our low volume node, at a fib level, in an already existing uptrend. Do you guys see how we piece these things together? And when we can align context, location, and confirmation, it gives us the most probability to be successful in this market. Even if you would have missed this trade, what happens is on this push up, and you know what? Let's talk about it. You guys see this? You guys see this? The CVD here went even lower. And the market is still moving up. There is still more aggressive selling hitting the market, but it's not going down. If the market is an auction and there is more selling than buying, but the market cannot move down, a passive buyer has to be in play with limit orders, absorbing all of these market orders from the sellers with the intention of moving the market higher. This only makes more sense when we've already established that the market is already in an uptrend. It pulled back to a low volume node created from these buyers. It pulled back to a fib level so buyers can refill their position. I mean, guys, when you can align these things, you take insane trades. And the rest of the day, up until noon, I believe, we pulled back to this little area of low volume created from the initial move up right here. Quick pullback, sellers got to fill. You can see more selling going on. But once the sellers are worn out, the market rallies. And the market continues to move up until the PM session. And once sellers are worn out, that is when you see these huge moves to the upside. So if you can first understand what the overall trend of the market is, you can understand where we're at in the market, and then if you can read order flow to see who's in control between buyers and sellers, your trades will exponentially increase and your win rate will be higher and you will eliminate the dumb trades that you've been taking. Now, what we went through today was a step-by-step system for being able to frame your trades. However, you need a proven strategy that is able to extract money from the market on a consistent basis. What I mean is order flow, because if you are able to identify the context and you are able to identify the location, you still have to be able to understand the relationship between the buyers and sellers at these key levels to have the fullest edge in the market and be able to identify who is in control and who is moving the market. And you don't have to take it from me. Guys in my Discord who have been trading for years like Toad failed to pass combines, and after his first one-on-one with me last week, just passed his first combine yesterday and is well on his way to his payout. Or we can use guys like Matt, who has been trading for over 2 years, failed to pass combines and never was able to get a payout. 3 weeks after working with me, Matt was able to not only take 3 payouts and pass multiple combines, he was able to make about $6,000 to $7,000 in a month. Matt completely transformed his trading once he incorporated order flow into his trading. Or even like Logic, who has been trading for only 6 months and has only been trading order flow for 2 months, but in under 6 months he was able to take his first payout, and after killing it, he is well on his way to taking many more. I firmly believe that understanding the relationship between buyers and sellers through order flow is crucial to being able to be profitable in this market. What I'm going to do is I'm going to link my Discord below, where I will be doing multiple videos a week and showing you guys step by step how I read order flow. That way you can incorporate that into your trading. I also recommend subscribing to my channel, where I'm going to be doing 1 to 2 order flow videos a week, where I'm going to be giving out my full strategy. That way you guys can become profitable with order flow too. If there's anything else you guys want to see from me or have questions, leave them in the comments below, and I will see you guys in the next video. Deuces.